Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Brian Hughes, National Mid-Market and Private Markets Group Leader for KPMG, about the results of KPMG's recent survey of middle market executives.
Okay, obviously the revenue expectations of middle market companies, and this has been confirmed by several sources over a period of time here. Middle market companies are pretty optimistic about their future. Maybe not the future of the economy as a whole, but certainly their future in terms of revenue growth and profit growth. In terms of the revenue growth aspect of that, I guess I'd be interested to get your sense of color on where they're expecting revenue growth to occur in terms of, be it organic, is it new markets, new products, acquisitions, etc. I mean, do you have a feeling for that?
Yeah, I think when you looked at the survey, you could see that so one of their top initiatives, at least as an entity, was to get organic growth. And from an organic standpoint, you can get that through geographic expansion. New product or services is typically the way you do it. And I think, as you saw in the survey, 48% expect geographic expansion to be the top area where they're going to get revenue growth. And when you dig a little bit deeper within that 48%, most of them expect it to occur within the U.S. and then secondarily within emerging markets. When you get beyond their geographic expansion, the relative investment that they were going to make that would generate additional revenues in the area of new products and services was only 26%. But nonetheless, new products and services hopefully will generate incremental revenue, if not in the current year, in future years. But we also found that 26%, of the respondents also talked about acquisition of businesses, which, as you know, tend to be in the mid-market, tend to be companies that are producing revenues. So they're able to, if you will, acquire inorganically the revenue of the acquired companies. So I would probably tell you, as these companies look at it, they've got inorganic and organic growth, and it's coming from acquisitions, new products, and geographic expansion, with probably geographic expansion being on the top of the list.
With respect to geographic expansion, there was something that I noticed that, and maybe I'm reading it wrong, but struck me as being very interesting, because your survey breaks things down between private companies and public companies. With respect to geographical expansion, it was striking to me that the private companies appeared to have a much a much wider risk acceptance than public companies, both within the U.S. but also in terms of emerging markets, which I think is really interesting. I mean, I would have thought it would be just the opposite.
Well, it's really that way because the public companies, of course, are under quarterly reporting requirements, and therefore they tend to take sometimes a short-term view in terms of opportunities, whereas the private companies are a little bit more nimbler and they can look longer term, and they're not necessarily concerned about short-term impact on results. And right now, as you know, the emerging markets are in a bit of a decline, and it's usually a good time to invest when markets are in a decline in terms of making investments. So the results actually didn't surprise me because of that very reason, that public companies unfortunately take a short-term view, whereas the private companies could take a longer-term view.
One of the other things that popped out to me was in the the data analytics, the big data is becoming widely accepted now, which is great in the middle market. Two things. The first thing being, your survey indicates that executives are viewing big data and the advances that one can get from that. The number one thing that they want, or they think they can derive from it, is internal operating improvements, which I thought was interesting because, so much of the talk about big data is about understanding your customer and basically, figuring out the shoe size of your best customer, right? And what he's talking to his wife about. That struck me as being interesting. I mean, any thoughts on that?
Yeah, well, I think when you look at the results, the percents were obviously pretty close. 33% were doing it for operational excellence, and 29% were doing it for, acquiring customers, which has the revenue. So, the operational excellence, of course, is focused on, cost savings, also consolidation of vendors, and I think when we looked at it in terms of operational excellence, it was specifically around operations and supply chain. So I think a lot of companies saw an opportunity to look into their own purchasing and the way that they're producing product, and being able to leverage data analytics to hopefully drive more efficient, supply chain and cost cutting was seen, at least in the short term, as a very good opportunity. But on the flip side, they also, as I said, 29% came along and said, hey, acquiring customers, that's going to be very useful to us to drive the top line. And then 28% said competitive intelligence, which, again, tells us more about what maybe our competition is doing, which helps us, obviously, also from a revenue and a cost side. So although they were close, I think, the operational excellence piece, again, was focused on the ability to streamline and improve margins without necessarily having to increase revenue.
And I guess the other part of that jumped out at me was that when you compare that to the technology spend or the anticipated technology spend, that seems to have it didn't seem to it decreased significantly from 2012. I'm not sure how those two things go together, unless people have already made their investment in big data. I don't know.
Well, so the one way to look at it is the question, again, what was asked last year. I think the response was 43% expected IT spending to increase from 2011. And then this year, when asked the same question, I think 31% said they expected to increase from last year. Well, if you think about that 43% last year that has already increased their spending, if you were to compare that potentially on a year-to-year basis, they may be remaining flat. So I don't necessarily view it as a negative. As you know, data analytics has gotten more notoriety in the last 2 to 3 years. So some companies have accelerated their spending, and in fact, their IT spend, when they answered the question in the current year, may be flat because they've made some of those investments in prior years.
Right, they've already done it, yeah. Okay.
Yep,
yeah.
Exactly.
That makes sense. Okay, I got to ask it. What are you hearing from the middle market folks? I mean, obviously, in the survey, the regulatory issues and
right.
sort of the governmental issues in general pop out big time. I mean, what are you hearing with respect to Obamacare, the shutdown, the debt ceiling, et cetera?
Well, that's obviously a current issue. Didn't necessarily we addressed, obviously, when we did the survey, that was well before the government shutdown. But Obamacare, of course, was known about, and Dodd-Frank, and I think as you're seeing in the marketplace, we've seen some large companies start to make some moves in terms of what they're going to do with the Affordable Care Act. What we're seeing, at least in the mid-market, I think is sort of wait and see in terms of where directionally things are headed and which might be, the better alternative for the companies. Some big companies have made that decision already, including a company here locally in Philadelphia called Aramark, which just went public, and they've announced that they're going to adopt the exchange system for their employees, and thereby shift, from having to provide it in-house to obviously letting them choose it out-house. But on the Affordable Care Act, I think we're seeing the mid-market sort of sit tight and see where things are headed. As you know, the exchanges aren't quite operating as well as they should be right now. On the other side, with regards to the government shutdown, clearly it's short term as long as, October 17th comes along and, Congress and the Senate and the President are able to, get an extension of the debt ceiling. If they don't, then, of course, I think that could have more what I would call short-term impact, just because it will reduce the confidence that the people have in the government, and their ability to pay their debts, which would cause, interest rates to spike and would cause potentially some, short-term shut-off of capital to businesses. But, I think, we all expect that won't happen. So, my expectation then, unless that happens, that there'll be very, little impact on, the mid-market in terms of the results that we saw in the survey.
Right. Right. I guess this sort of dovetails into that. There was actually a survey put out by the Conference Board today that surveyed larger companies, CEOs, and it's the confidence index basically for CEOs, and that showed a dramatic reduction. The large company CEOs seem to be quite pessimistic, or at least much more pessimistic than they were in the second quarter. Whereas pretty much, certainly your report and various other data points suggest that middle market CEOs are actually quite optimistic. Why do you think that is? It just seems an interesting dichotomy,
Yeah, well, I think the mid-market companies, just because of their size, they tend to be more agile, nimble. They're driving, innovation. They're moving faster. They can act faster. They've got, cost-cutting capabilities with less decision-making. So I think it's all of those reasons that, the mid-market companies tend to be able to be more optimistic, whereas you get in a large, complex multinational that's, over a couple billion in revenue, the decision-making process is much more entailed, and so therefore they're not able to act as quickly, and so therefore they tend to feel maybe not as positive, because if they need to do something, they can't do it quickly. Whereas the mid-market
the adaptability concept, yeah. Right.
Exactly.
Right. I always chuckle when I ask this question, because it's been a question. It's been a statement that's been made for about 3 years. This explosion in M&A activity right. coming through the middle market, and it just keeps coming. It's like the recovery summer, right? It just doesn't seem to happen. Is this the year? The next 12 years, based on what you're hearing?
Well, I think, as you know, we saw an increase at the end of 2012, just because of the increase in the tax rates that occurred on January 1. And what we're seeing right now, we're seeing a lot of activity, but there seems to be a large gap between valuation expectations between a buyer and a seller. So we're seeing, the buyers obviously in this environment, or at least for the mid-market, their expectations of value are a lot higher than the sellers are a lot higher than the buyers. But you also have to think about, on these mid-market companies, even though I think you mentioned the aging baby boomers, you have to think about whether some of these companies, of course, get passed down from generation to generation. So unless you're in a company that really wants to get out of the business, some of these family-owned businesses get passed down.
Right.
But we do. The short of it is, we do, assuming debt ceiling gets lifted and the economic activity continues, even though it's at a moderate pace of 2% GDP growth, we do expect to see an increase in M&A activity. Whether it occurs this year or in 2014, I couldn't tell you, but I think the general trend is we expect it to see an increase.
Be sure to check back for future editions of the President